Hi all, welcome back to my YouTube channel. I hope you all are doing fantastic and you're preparing well for the exam. Topic that we'll have a look at today is from paper one, that is Foundation of Risk Management, and its chapter name is Modern Portfolio Theory, Capital Asset Pricing Model. And like given the exams are going on, we'll see a nice question from the exam. And please do subscribe to my channel, like, comment, and share with your friends as well who are preparing for the exam next month or planning to have it next year. So let me switch on the pen. Yeah. So we have been given some information about three stocks, their price today, and the expected price in a year, and the expected dividend in 1 year, and their beta. And we have been given some information, that is risk-free rate and market return. So think of market return as return on the Nifty index or S&P index. And what we have been asked is we have to determine that which of these stocks are if these are undervalued, overvalued, or these are properly valued. And accordingly, we have to choose a correct option. I mean, we have to uh, conclude that if all the stocks are overvalued, undervalued, properly valued, or some stocks are undervalued, overvalued, and vice versa. So before we go ahead, I'll just give you some background and thumb rule to solve this question. Basically, your SML equation is SML is a representation of capital asset pricing model, and it talks about what is your expected returns on the stock, and you need some basic information if you want to arrive at this information. And just intuition behind this is if you are investing in the stock, some stock I, how much return you will expect, it is determined by risk free rate, how much you earn over and above risk free rate, and this over and above is beta time your difference between market return and risk-free rate. This is called as excess returns. How much returns that you earn over and above market return, and how much that is sensitive. So beta is market sensitivity of the stock. How much that is. So multiplication of these two added in your risk-free rate. See, say for example, if you are investing in the saving account or a fixed deposit, so this component won't be there. You just earn a risk-free rate. But if you are taking some risk and if you are investing in the stock, this component will come into the picture, and this will give you how much return you can expect given the beta and this RF. And your if your rate of return required by SML, that is derived from this equation, are less than something which valuation analyst has arrived at, then you say that it is undervalued by the stock. And if your SMLs, so this if this equation gives the expected returns which are higher than what valuation analyst is predicting, then it is overpriced. Then you can sell it. So let me just turn back to green. So I'm explaining this rule number one, where your required return determined by CAPM. So this is derived by CAPM, and this point is determined by analyst. Okay, so in case if your CAPM is expected return derived by CAPM or less than analyst, then your stock is undervalued. You can buy it. This is rule number one. And likewise, if your so if you see this point is slightly higher than what valuation analyst has arrived, so this is CAPM, and this is analyst. Okay, so if your CAPM is greater, so over here also CAPM is greater than analyst, then your stock is overvalued, then you can sell it. So this is number 2 and number 1. So this keeping in this in mind will solve the next this question and arrive at the conclusion which of these 3 stocks are fairly valued, overvalued, undervalued. So see, this is the same table that was given in the question. So this is stock A, B, and C. What I'll do, I'll calculate expected return as per CAPM slash SML and expected returns as per analyst, and we'll see if I'll just say that CAPM is less than analyst. If your CAPM is less than analyst, first case, then it is undervalued. If your CAPM is greater than analyst, then you say it is overpriced. So we'll calculate the both. So let me write down some information that was given. So we were given RF as 8%, RM as 16%, and our expected return as per CAPM was RF plus RM minus RF times beta. So I'll just write down this information over here and we'll see. So your RF was 8% plus 6, so 16% is my market return times less 8% into this is a beta that we have been given. So this is a beta of the stock. This is pretty straightforward. 8% minus 8% will get cancelled and this would give 16%. How this we have to calculate this, we'll see. So this is 16%, and over here again it's RF is same 8%, RM minus RF time over here the beta is 0.8. So 0.8, I'll just write it down first, then I'll calculate it and put it here. It's also 8%, same 8% my 16% minus 8% times here 1.2. So 1.2. So let me just I had calculated. Let me check my paper. Yeah, the second one is 14.4%, and the third one is 17.6%. Now what we have to do, we have to calculate the returns as per. Let me just try some different color to make it observable. So that when we'll be comparing, we have straightforward numbers available. This is your 16%. This was your 14.4%, and your last one was 15.6%. This is your CAPM. And now we have to calculate returns as per analyst. How I'll calculate? It's very simple. So we have been given price today, expected price 1 year later, and dividend. So in between year you get dividends also. So I'll just apply the simple formula. Returns is equal to your final price minus initial price divided by initial price. But your final price would be your actual price and you receive dividends as well. So your price 1 year down the line and plus dividend. So price final plus dividend. So what we'll see over here, the final price would be it's 28 plus 1, 28 plus 1 minus your initial price was 26. This completely divided by 26. We'll see how much it is and we'll write it down. Similarly, in the next one, the final price is 46 plus 2 units dividend, and the initial price was 40. So final price plus dividend minus initial price divided by initial price is equal to, and in the last one, the 18 plus 0.83 cents dividend. So 18 plus 0.83. This is my final price minus $16 divided by 16. Let me just quickly write it down here. Let me change the color of pen so that we can directly compare the numbers. So this one is 11.54%, and next one is 20%, and last one is 17.69%. So if you see, in this case, CAPM returns in the last two cases, CAPM returns are less than what analyst is predicting. So this one, the first case, SML less than expected return by analyst. So 17.6 is less than 17.69, 14.4% is less than 20. So these two stocks are undervalued. So the stock B and stock C are undervalued. And in this case, the 16% is greater than 11.45%. So value. So if you see pictorially also, this is the case. SML is predicting high and analyst is predicting less. So this is overvalued security. Change the color. So this is overvalued security. It still did not change. Sorry. This one is overpriced. So your stock A is overpriced and B and C are underpriced. So we'll select the correct option. Stock A is overpriced and B and C are underpriced. So A is overvalued and B and C are not sure why color. There is an issue with color is not changed quickly. So here we go. D is the correct option. Hope you like the video. If yes, please do share with your friends and colleagues who are preparing for the exam or they have future plans to pursue FRM, so that they have the basic understanding of the topics, and it will definitely make them more curious to know FRM curriculum. So please do share and subscribe to my channel. Thank you for staying till end of the video. Stay connected. Thank you.